What is stock? An equity security, also known as stock, is a form of investment that represents a portion of a company's stockholders' equity. Shares are the smallest units of stock. In many individual investors' portfolios, stock purchases and sales are made primarily on stock exchanges, though private transactions are also possible. Types of stocks. The first type of stock is called common stock. The most common type of stock to invest in if you're just starting out and looking to buy a few shares is a type called common stock. You have a stake in the company's profits and the right to vote if you own common stock. It is possible to receive dividends, which are payments made to stock owners on a regular basis, but these dividends are usually variable and not guaranteed. The second type of stock is called preferred stock. When it comes to preferred stock, it's often compared to bonds. Investors typically receive a fixed dividend from it. Preferential treatment is extended to preferred shareholders as well. In the event of bankruptcy or liquidation, preferred shareholders receive dividends first. What is stock market? Stock market is like any other market where we purchase and sell goods. A stock market is a location where stocks may be purchased and sold. Stock values tend to rise in the market if the economy is performing well. Stock values rely mainly on the success of the company. Stocks are issued by companies for a variety of reasons. Companies issue stock in order to raise money for expansion and growth. By selling off a portion of a company's profits, corporations can raise money. Equity financing is another term for issuing stock, as the shareholder receives a share of the company's voting rights and profits in exchange for their money. In addition to the risk of losing your money, becoming a stockholder in a company entails the risk that the company's value will not rise and you will lose your investment. If a company goes bankrupt, you have the right to claim your share of the company's assets after all debts have been paid. As a result, the banks and bondholders will have absolute priority in claiming the assets. You can buy stock in a company in one of two ways. You can buy stock in a company's IPO, or initial public offering, when the stock is first put on the market. When a company is looking to start or grow a business, it may offer shares of stock on the primary market. To buy stock in the secondary market, you can use stock exchanges, where the stock is traded. A company may choose to issue stock in order to raise capital for a variety of reasons. Reasons for this include the creation of new goods and services, to buy new buildings or equipment, reducing debt while simultaneously increasing stock, to get ready for an acquisition or merger, enhancing a company's worth, to allow for a greater degree of customization. What is stock market index? Investors use a stock market index to gauge the health of an economy. An index gathers information from a wide range of businesses. Investors can use this data to compare current price levels with previous price levels and come up with an overall picture of market performance. For example, a subset of the market is targeted by some indexes. The Nasdaq index, for example, closely follows the technology sector. The Nasdaq stock index is a good indicator of how technology companies are doing. Some indexes only track a handful of stocks, while others look at thousands. Because different investors have a vested interest in various sectors, each index serves a specific function. Not all stocks are rising or falling on that day by looking at the stock market. This is understood by knowing the stock market index. Indexes are created by grouping together similar stocks. These stocks may be classified together based on their capitalization, industry, size, and other characteristics. There are a plethora of stocks available on the stock market. If you do not group comparable stocks, the situation will become chaotic. In order to correctly read an index, you must observe the index value's evolution over time. To get started with a new stock market index, the stock prices at that time are used to calculate a predetermined starting value. Component stocks prices will be taken into account when future index values are calculated. However, because not all stock market indices start with the same value, using points to measure index changes can be misleading. To put it another way, if one index rises 250 points in a day, while another only rises 10 points, it might appear that the first index did better. If the first index started the day at 25,000 and the second index started at 250, you can see that in percentage terms, the second index gained more. Focus on percentage gains rather than point movements when it comes to investing in funds that track the stock market index. The most popular stock market indexes, on the other hand, aren't always accurate measures of the overall market's performance. Finding out which stocks make up a particular index can help you figure out what factors are driving that index's performance, as well as why other indices aren't following suit. You have total command over how much you want to remain invested in the stock market. There are no clear and fast criteria for determining whether an investment should be classified as short-term or long-term in nature. The difficulty with long-term investment is somewhat more challenging to anticipate how the market will react throughout your investment. It is also essential to consider the objective of the investment. If you're looking for fast cash, a short-term investment may be the best option for you. Long-term investments are the best option if you want to save for your retirement. A person's expectations are based on the nature of the investment, which can be short or long-term. Investing in something that one intends to keep for a long time is expected to increase in value. To profit from an increase in the value of an investment, like a stock, the owner sells it on the open market. As an alternative, short-term investment vehicles, such as a certificate of deposit, CD, or bridge loan, may be considered when someone wants to make a short-term investment to earn money. In most cases, short-term investment vehicles are purchased to protect the principal. The benefits of short-term versus long-term investing are best suited to different stages of life. Short-term and long-term investments may be ideal for those who are just beginning their careers. To help with the down payment on a mortgage, short-term investment vehicles can be used while long-term ones can be used to save for retirement. Short-term investing may become more important after retirement. All of this, of course, depends on the overall goals of the person concerned. According to long-term goals, one should consider a long-term investment in order to acquire the resources needed for a project, such as the purchase of $1 million house. Investing in a short-term strategy is preferable if you need a specific amount of money at a specific time. Buying a car or taking a vacation can be the answer. We're talking about investments that necessitate a degree of risk-taking. All investments have a different level of risk associated with them. Investing in government bonds is risk-free, while putting money into new businesses without a proven track record or lending money to companies in financial distress is risky. When it comes to returns, the bigger the risk, the more money an investor can claim for taking the risk. Volatility in the financial markets is a major risk for long-term investors, as it can cause investments to lose value. For short-term investors, the main risk exposure is the purchasing power risk or the risk associated with inflation in this situation. As inflation rises, the value of a currency depreciates, making investment returns worthless. Investing in both short-term and long-term investments is common practice for investors. It's important to diversify your investments in order to reduce your risk. Investing strategies for the long term. For the purposes of this discussion, long-term investments are those that one intends to hold onto for a long period of time. By determining the rate of return they are willing to accept, long-term investors approach investing. Dispersion is a term used to describe the fluctuation in the value of an investment over time. A temporary drop in the market does not mean that investors should rush to get rid of their investments. Cyclical markets always recover from declines. Exactly how long does it take for someone to recover? Investing in company stock is a good example of a long-term investment. If a company in an industry has a business model that you believe in, you can invest in it and stick with it for a while. Bonds that mature in 10 or 30 years are another long-term investment option. A government bond or a corporate bond can be used. It's important to strike a good balance. Investors must strike a delicate balance between risk and reward in their portfolios. So make sure they know what they want to accomplish before they begin investing. Investing in both short-term and long-term instruments provides investors with a good level of diversification. Myth number 1: Gambling. Well-meaning but misguided advice is often used to spread this myth about the stock market. People may advise you against investing in stocks because they are worried about their own losses. However, comparing the stock market to gambling is a gross misrepresentation of what it is all about. There are a number of factors that go into stock market investment that aren't involved in gambling. The market's history, current economic conditions, and information about the company you're interested in investing in are all included in this. Like gambling, these factors can be studied and forecasted to make profitable investments, unlike the randomness of gambling. Myth number 2: Become a millionaire. In the stock market, there are some high-risk investments that can pay off for some traders. There are exceptions to the rule, however, when it comes to high-risk investments and returns. Investors would only trade in high-risk investments if this correlation was true. High-risk investments, on the other hand, come with an equal likelihood of big losses as big gains. High-risk investments require caution, patience, and thorough research before you can put your money into them. Keep in mind that some of the industry's biggest names amassed their fortunes through a series of small, low-risk investments that paid off in the long run. Myth number 3: Only wealthy person does stock trading. One of the most common misconceptions about investing in stocks and bonds is that it is only for the wealthy. This myth is based on the idea that in order to make money, you need a lot of money to cover all of your losses. This, on the other hand, is completely misguided. The stock market, like any other investment option, provides a wide range of options for investors with different risk appetites and capital. To get started, all you need is a trading account and a small amount of money. What matters most is identifying the best companies to invest in and creating a plan to limit your losses from the outset. Myth number 4: Connection with people. It is commonly believed that only those people can invest in stocks who have connections with many people. It is not true. Having relationship with many people does not always guarantee good information. Therefore, you should do your own research to get right results for you. Myth number 5: You must be an expert of financial knowledge. Several investors worry that the stock market is a closed shop, reserved for a select few, and that they will be unable to participate. As a matter of fact, anyone can participate in the stock market and benefit from its advantages for wealth creation. Investment in the stock market does require some knowledge of the market, as well as an understanding of which stocks are right for your risk tolerance. It's important to remember that learning is a dynamic process that evolves over time. Because of this, the stock market is accessible to anyone with a keen interest in. Open a trading account with a reputable broker and begin trading. There are various investment strategies in stock trading. We will be looking detail about each strategy. Such strategies will include passive and active strategies, growth investing, value investing, income investing, indexing, dividend growth investing, contrarian investing. The basics of a company are examined in a fundamental business analysis. On the stock market, a company's performance is the primary factor in determining a stock's success. Business's cash flow and financial accounts are scrutinized as a result. Rather than focusing solely on financial gains, you should aim to reap the full benefits of running a successful company. Technical analysis. There is a lot of emphasis on studying graphs and charts that show how stock values fluctuate over time. If you pay attention to price movements, you can learn a lot about the market. The most important thing to remember when employing this strategy is to look for patterns or trends. Don't force yourself into making patterns. Even when there are no patterns in the real world, our minds create them. Don't bother looking for a pattern if there isn't one. Value investing. Investing in a company that is currently trading at a discount to its true value is the goal of this strategy. You need to be able to spot and profit from mispriced assets. Look for low-priced, high-quality stocks that have a good track record. It's widely accepted that the market will eventually correct itself. For example, if you buy shares of company A for $25 per share, but the stock market price is only $15 per share, then your investment must be a success. Value investing. Value investing focuses on the here and now, while growth investing focuses on the here and now. A growth investor may choose to buy a stock that is currently being sold at a price that is higher than its actual value. Investing can be considered successful if an analyst predicts that a stock's price will rise in the future. There is a lot of potential and room for growth in small and startup businesses. Qualitative analysis. This strategy emphasizes the importance of a company's overall performance. You must take into account the personalities and backgrounds of the company's leaders. Keep an eye out for the company's top executives, including their educational background and previous employment history. An educated guess about an individual is often easier to make. If a company is made up of the world's most successful business people, it is likely to succeed. Stocks in the company are expected to rise, making it an excellent investment opportunity. Stock split. Usually, it's announced by a company when its stock price has surpassed a level that no longer attracts investors. A stock split, for example, means that if you have 30 stocks each valued at $20, you will have 60 each valued at $10. It's a reasonable point of view. The split will result in more shares being issued, but the value of those shares will decrease as a result. It is not necessary to divide a single stock into equal parts in order to perform a stock split. 3 or more shares of stock can be split in a stock split. As much as you can, do your research and analysis on a company. Income investing. To locate well-established companies that are a reliable source of income. You become a shareholder when you purchase stock. As a result, you'll be able to collect dividends. There are many large, well-established companies that are no longer interested in expanding. Rather than reinvested in the company, these businesses distribute their profits to shareholders in the form of dividends. For example, consider Johnson & Johnson. Stock mastery. You should focus on one stock or business each day until you have a thorough understanding of how that stock or business operates. In order to make more accurate predictions about a stock's future course of action, you need to gain more knowledge about it. Investment decisions should not be made in a hasty manner. To maximize your chances of making a profit, only invest when you are confident that the chances of success are high. Averaging down. This is a risky strategy. Pick a group of stocks that you think will be profitable in the future. You can repurchase the stock at a lower price if the price of the stock decreases. You'll reap the benefits when the trend picks up steam. If the value of the stocks rises significantly above their initial purchase price, you will make a substantial profit. Each time you bought the stock at a bargain, you can expect to make a sizable profit when the price rises. Buy and hold. This is a common way to invest in the stock market. The long-term value of stocks is expected to rise, despite the fact that short-term market direction cannot be predicted. Because excellent stocks can be held for a long period of time, you'll reap the rewards later on.